Welcome to Better System Trader Live, the show where we talk about all things algorithmic and systematic trading. And today we have a fantastic guest, Jason Strimpel from PyQuant News. Welcome, Jason.
Andrew, thank you. Huge fan of the show for a very long time, so it's a pleasure to be here with you today.
Thank you very much. Well, I'm really excited for our discussion today because I've been following along with your epic Twitter threads and content and newsletter. You publish some really great stuff, probably some of the best stuff out there in the industry. So I've been following you for a while, and I can't wait to dig into some of that content today. Now, our official title is, it's gone through a couple of revisions, but here's what we've got at the moment. How traders can compete in the markets and find profitable edges. Now, I saw you actually say this, I think in a more eloquent way. How can non-professionals compete in the markets? It's a very good question. But before we even get into all that, how about share with us a little bit of background on yourself, just so that we can get some context on our discussion today.
Yeah, thanks, mate. Happy to. I'll keep it pretty tight, but I guess you can say I've been in capital markets professionally in one way or the other my entire career, which is about 20 years now. Started trading and programming when I was like 18, so I'm 42 now. So 20 plus years been programming and trading. Career-wise, I started off as a hedge fund trader in Chicago for a proprietary shop, moved on to JPMorgan, ended up doing quantitative credit risk analysis for derivatives business, and then market risk analysis, and then kind of left the grind of trading, moved up the career ladder, got into quantitative risk analysis, moved out to Singapore where I did that for a egg trader, did some capital venture investing in crypto, built a data and analytics team for a metals trader, and all the while kind of using Python, learning Python, and of course trading typically options, U.S. stocks and options in the background.
Wow.
Yeah.
So you've got a lot of exposure into a lot of different things, I guess. So yeah. What was the initial appeal of getting into trading? Why did you do that? Because it's not easy.
Yeah, it's not. It's a very difficult way to make a living, that's for sure. Somebody asked me that recently, and I like to say that it was my grandfather who allegedly had bought some Microsoft stock at the IPO and allegedly was talking about the stock market a lot when I was a small kid. But the earliest memory I have was my friend's father was a stockbroker and he drove a Cadillac. And to my own dad, the Cadillac was like the creme de la creme. That was the vehicle that everybody wanted. And I was like, oh, this gets dad stocks, Cadillac, that's got to be good. And kind of ever since then, it was just a hunt for complexity, hunt for alpha to this day.
Hunt for complexity. That's interesting. I think we might dig into that one a little bit more. I like that statement. So did you end up getting your Cadillac?
I did. I ended up driving a Cadillac for about 18 months. Unfortunately,
you did?
I put some big tires on it and it blew up the transmission. So it was short-lived, but I did have a Cadillac.
Okay, fair enough. So on to the topic of the show. I guess we've got a lot to discuss here today. Yeah. So when we were kind of throwing around ideas for what the theme of the show could be today, because obviously you got a lot of different backgrounds and experience, we could go any direction. And when you said something about how to compete in the markets, that really kind of resonated with me, because we've seen the stats out there. Most traders fail, right? It's a very tough market. It's a very tough way to make money. The markets are really competitive. There are people in the markets who have a lot more resources than you and I have, or maybe you've got more resources than me. But it's really a difficult way to make a living. Why do you think? Why do you think it's important to have a discussion like this outside of just the high failure rate?
Yeah, it's a great question. We're talking kind of about the context here of algorithmic trading. So I do want to start by kind of drawing that distinction between how I consider algorithmic trading versus what you might hear about, or obviously discretionary trading. I think the biggest difference is in algorithmic trading, you're relying on data and models in a very kind of rigorous way to assess whether you should be in the market or not. Whereas on the discretionary side, you're looking at charts, using your intuition, using your experience. Yep. And I think a lot of time when we hear that stat, it's a lot of the discretionary traders that aren't up for it. And I think when you're just starting, the easiest way to get started in trading is like pull up your charting software, look at 2 technical indicators, see where they cross, and then you enter your trade. And I think where people get into trouble is they assign luck to skill. And as many experienced people will know, there's very little edge in any strategy. And I would posit that for most beginners, there's zero edge in any sort of discretionary trading. And if you're making money, you're probably just getting lucky. So that's kind of the harsh truth. I think that it takes a lot of market tuition to learn. So on the other end of the spectrum, like when we think about algorithmic trading, we think about using data to capture market inefficiencies and try to then determine with statistical significance if you're getting lucky or if you've actually found something interesting.
Yeah, I think that's an interesting progression for traders. Well, a lot of the traders I know started off doing discretionary trading, and some I think probably were quite lucky. And over time, they pretty much almost every trader I know gravitates towards algorithmic or quant-based trading because I think there's a point where they realize, first of all, it's a lot of the time it's not sustainable to look at charts, depending on what time frames you look at, and there's no real way to verify that what you're doing actually works. And one of my experiences is when I joined a prop trading firm, and they part of the package was we'll teach you all these trading strategies, and I was trying to apply them and they didn't work, and then I actually went and back tested them, and they were rubbish. And there's always this thing like, oh, there's nuances to this and that. You've got to get a feel for it. But like, how can you test that kind of stuff? So in your work with traders, I know you've worked with thousands of traders. Do they just start in quant or algorithmic trading, or is there a progression to get there? Like, how do other people that you work with get to that space?
It's a great question. A lot of the people follow the path that you've kind of mentioned. If you can be successful long enough to kind of stay in the game, then you will eventually get to a point where you're at least putting some systems in place. So you might still be kind of just trading discretionary like strategies, but you then start to automate those strategies. You start to use, there's very good accessible trading software that is based on these kinds of things. You can do your technical analysis, you can do your indicators, and you can automate a lot of that. But I tend to find that the longer people are in it, the more creative they get in the way that they think about finding these repeatable patterns in the market. And they get more creative in the way that they can tell stories. And I'm kind of segueing a bit into like this concept of edge, but they get very, very, they get outside of just price, right? And I think that's the biggest inflection point that I've found in most experienced and successful people in this, is that you move away from just looking at price and you start to look at bigger relationships. And the more you look at the bigger relationships, the more you need data, the more you need more powerful tools than just Excel or your trading view to start to bring all of this together. And with all of this data, then you need more sophisticated techniques. So that's, where you start to get into that quant side, which is statistics and even machine learning, to apply patterns and detect those patterns. So that's kind of the evolution that I've generalized over time for most of the people that are, through my courses and that I talk to that are still successful. Yeah.
Now I know we're going to get into talking about edges in a little bit, but do you think then that, or is the underlying premise with what you've just said there, that there's less of an edge now just relying on just the chart patterns and you need to look wider to find those inefficiencies?
Yeah, for sure. So I kind of think about this in 2 buckets. The first is like a data mining approach. And the second is like this market inefficiency approach. So the data mining approach is, let's just brute force through every single indicator or signal that we can find, and let's optimize the parameters until we find something that works in sample, and then try to trade that out of sample. And the good part of that is like, it's easy. Relatively speaking, you can get data pretty easily. You can run some loops, and novice programmers, intermediate programmers can kind of do this thing. But of course, the downside is every single there's thousands or not millions of computers doing exactly this same thing. And they're doing it at scale, and they're doing it every second and every nanosecond, 24 hours a day. So, all of these market inefficiencies and all of these kind of nuances in the market get squeezed out, and there's nothing there left to compete against. On the other end of the spectrum, you've got this kind of concept of a market inefficiency, where this is harder because you need to use more sophisticated tools. You need to do more modeling to find the market inefficiencies and the patterns that are repeated in the market data. But once you do, you can find a more robust edge that'll last longer. And, we can talk about an example of that next, but I typically shy away from the data mining approach. I'm not trying to brute force optimize anything. I'm trying to take a more creative approach and a more thoughtful approach to come up with a story and then test that story, test that hypothesis, and find evidence to suggest that there's something there.
Yeah. Well, actually, do you want to just give us an example then? Because I've got a bunch of questions that I want to ask about what you've just said, but maybe an example just to kind of wrap up what we're talking about here would be helpful. So do you have,
Yeah, sure. I'll give you like a real strategy that's been working for a long time. I think, Andrew, when we spoke last week, I told you some of the traders call it taking money from a baby. It's this this crack spread versus refiner stocks. So a crack spread is basically, it comes from the process of cracking crude oil into its constituent molecules. You're cracking molecules. And it's a machine in a refinery called a cracker. It's actually a tank. And you got to think about, if you take a barrel of oil and a refiner pays $80 for a barrel of oil, they crack it and then they produce jet fuel, heating oil, all of the constituent refined products, and they can sell all of those products for, it's called $120. Then there's a $40 margin, right? So this is the crack spread. And as that crack spread increases, you would expect that the refiner margins are improving. So therefore, you would expect stocks with a high level of exposure to these refined products and these input products, you would expect that those stocks would increase in value. So a great example of this is that doesn't always happen. Now, if the crack spread starts to expand, you can measure quantitatively whether the stock is increasing or it is not increasing. Now, you can look at it on a chart, of course, but there's some fairly straightforward statistical methods that you can use to determine whether that stock is increasing as well. So that is a market inefficiency if you think about it, whereas the fact that this crack spread is increasing implies that the refiner margins should be improving, and that should be priced into the market immediately. There are times where that's not priced into the market, and you can take advantage of that situation by buying the stock.
Yep. But so how did you actually come up with this, I guess, this observation of, crack spread has been talked about a lot, I guess, on the internet, but that seems to me like something that a beginner trader wouldn't even understand to look for. Mm-hmm. So do you need to have a certain level of understanding of the markets or some other concepts to even get to this point where you're like, oh, here's an idea, I'm going to test this? Like, where do these ideas come from?
Great question. That idea came from a community that I'm part of. So, as simple as a community. I think, though, there's kind of a mindset shift, which is, what I'm discussing is kind of economics like 101. That's like undergraduate economic stuff. And it's kind of just, you put yourself into like idea and exploration mode. And I think that's where a big gap lies in folks that are like non-professional or retail traders that are trying to do well here, is that this isn't all about looking at the markets and all about charts. It's all about like being very curious about the links between the markets, like the cause and effect that happens. There's a lot that goes on outside of the price action. And as soon as you can get your head out of the price action, out of the limit book, and start looking more holistically, you kind of put yourself into this idea creation mode, and you can start to get creative and start to tell these stories about how this stuff should behave. Now, it sounds like very kind of lofty and theoretical, but you've been doing this for a very long time. I've been doing this for a very long time. And eventually you just look for ideas. So like you said, it's not easy. So if you kind of just expect to rock up and like have a list of 30 ideas of which 25 will work, it's not going to work that way. It really takes time and a high level of curiosity to kind of dive into this stuff.
Yeah, yeah. I think this comparison of the, what did you call it, the data mining versus market efficiencies is quite interesting, because there's obviously people on both sides of the camps. So if I can maybe explore that a little bit more with an example for you. So let's say, for example, we've got two traders, Trader A and Trader B. Trader A has identified that, the last couple of months in the markets tend to rally, and the last couple of days in the month tend to rally, and also the first couple of days. No idea why, it just happens. It's a repeatable pattern, 80% win rate or whatever, depending how you trade it. So there's this observation. Trader B, he may work in a fund. Maybe he's like, okay, we get all this money that we need to deploy, capital deployment last week of the month and the first couple of days, and all my fund mates do the same thing. So, the market rallies. I've got this story. I understand why. Now, both of these traders have observed the same pattern coming from different methods. One has a story or a reason behind it, and one doesn't care. It's just like the data's the data. How do you think about that? Like, how do you rationalize? Is one more accurate than the other, or more correct? Correct.
Great question. Great question. I mean, as you know, ultimately it comes down to whether you consistently make money or not. That's the cop-out answer. I think the better answer, though, is for Trader A, who observed this pattern, it depends on what they do with it. If they were to take the algorithmic trading route, and if they were a curious person, they would seek to understand if there was something there. And yes, there are cases where there's just pure statistical anomalies, and you can take advantage of just pure statistical anomalies, and there's no real explanation for it. But in your example, if you're seeing like a rally at the end of the month or something that's repeatable like that, you might conclude that there's something driving that force. Okay. So I think in that case, the curious trader, Trader A, would go on, do data analysis, assess, collect evidence, whether that this is actually persistent. I think they would also try to test whether it's statistical significance. So to your point, maybe it happened the last 3 months or the last 6 months. Well, there's a difference between observing something and actually being able to express your view to take advantage of that thing, right? So the algo person would go run some backtests. They would try to model that market inefficiency. And once they have a model for it, they can continuously backtest and improve and see if there's statistical significance. I think on the other end of that spectrum of Trader A, they would just be like, oh, this seems to work. Let me just wait until Tuesday, 2 weeks before the month end, and I'll just wait for the pattern and kind of click it. There's no real curiosity there. There's just kind of like, let me look at the prices and go. On the other end of the spectrum, with the person who understands the rationale why, I mean, ultimately, they will probably take the following steps. They might just have a head start because they have that intuition as to why that's happening, but they should ultimately still try to model that, run it through their analysis to try to determine if there's statistical significance in a way that they will continuously be able to exploit that pattern for profit. Yeah.
Do you think there's other benefits to being able to assign a premise to a strategy or a model, for example, maybe like psychologically wise? Is it easier to trade? Do you have more confidence? Like what are the other benefits of having a premise to an idea?
Yeah, I think having I'm gonna kind of like cop out a bit and answer the question a different way.
That's okay.
Okay, so I like to think of it as like a link to economic reality. It's kind of saying the same thing. So I prefer, in the best case scenario, I prefer to have some link to economic reality with a strategy. A good example is that crack spread. Because if you're trying to like build a business here, and imagine trying to explain what your business is, and you're just like, I look at a bunch of data, I plug it into this black box, and out comes buy or sell.
Yeah.
Versus like, I consistently watch this crack spread, and I know that Valero doesn't react as fast as I think it should. So I'm going to take a low risk bet by shorting the crack spread and going Valero. you have a better conceptual framework on how to actually treat that trade in the future, how to hedge it, and when things go wrong, how to manage that risk. So that's the kind of ideal scenario, I think, for folks, but it's not always true. Like in principal component analysis, which is a statistical technique, I get this all the time. You run a bunch of data, you get n number of components that explain the variation in your data. And people are always at, well, what is it? Well, it's nothing. It's a statistical pattern in the data that we can't necessarily assign a label to, and that's uncomfortable. And if you're trading on this thing and you don't have necessarily a label to it and you don't know why it's reacting the way it is, that can be very uncomfortable because you don't know how to handle it if things go wrong. So I think there's some real practical reasons why working backwards from like an economic reality is air quote better than just coming up with a pattern statistically and trading that. But in the end of the day, if you're consistently making money in a pattern, I mean, that's kind of what matters.
Yeah. I think you touched on a number of really important points there, but the one that stood out to me is that if you understand why something or when something could go wrong, it kind of makes it easier when it does happen, because you've got an understanding of, this strategy doesn't work very well under these conditions. It works really well under these conditions, and this is why. So it definitely makes it, I think, more psychologically manageable in a drawdown, which is, one of the, I guess, the biggest challenges for traders is how to manage yourself in a drawdown. But I think you touched on a really good point there. Do you think that so the example you gave before about the crack spread, you're essentially, I guess, doing intermarket or inter-asset analysis, right? Looking at the relationships. Do you think by expanding into those and other markets or assets, does that make an idea more robust if you're getting confirmation from here and here, combining it all together?
Yeah, another great question. I think yes. It's kind of one of my favorite strategies where I can use one market as a signal for another. Now, in that example that I just gave, the way I described it, you're literally just using this crack spread as a signal to buy or sell a stock. Now, there's a bunch of normalization and a bunch of steps that you want to do to kind of, look for extremes. But the bottom line is you're basically using the futures market as a signal for the equities market, as a proxy. And that's a pretty innovative way to think about things. I also think that beginner folks or even experienced folks, they kind of get a little bit narrow-minded. It's like, this is my market. This is what I trade. I might look at 2 uranium stocks, or I might look at 2 oil stocks, or I might do some relative value thing between 2 assets or between 2 futures, or I look at the futures curve. But if you can start to construct, spreads in futures markets that reflect some economic proxy and use that as a way to signal the buy or sell of an asset that responds to that economic proxy, I mean, that's a very powerful, powerful mechanism. And what your question kind of made me think of something else. There's dozens of different ways to express your view in that one trade, and that's something else that I think non-professionals can focus on. Is if your signal is saying go long Valero, well, you can sell a call spread on Valero, or you can buy a call, or you can sell puts. You can express your view in many, many different ways. You can trade something other than Valero. You can trade Phillips, or you can put the crack spread on in a different way. Like instead of a 3-2-1 crack spread, a 3-2-3 crack spread, or some different combination. So there's many, many different variants in how you can express your view in the market based on that same strategy. I mean, we're not even talking about volatility here. Like you could even look for signals of volatility and put on straddles in the options market. Dozens of different ways to express your view in this single strategy. So not only can you use intercommodity prices to try to get an edge, but you can actually express your view in totally different markets. And I think that's one of the most exciting things for retail traders now is like you spin up your Interactive Brokers account, your Thinkorswim account, you have basically access to the entire world's markets. And you can do this type of analysis now with the tools that we have at our disposal.
Yeah. Would you ever express your view in multiple different ways, perhaps for like a diversification reason, or do you think it's best to have one idea or one view and one way to express it?
It's kind of a it's kind of a loaded question. I think it depends on your personality, honestly. I think, I talked to a veteran trader just a couple weeks ago, and this person said to me that, you should trade markets that reflect your personality. And I at first it was kind of like a throwaway comment, but it rings really true. Like, if you are risk on, 26 years old and risk on, then go ahead and punt on out of the money options, right? If that's your game. If you are 42 like me and you want something slower, then you just run a monthly factor strategy where you push a button once a month and rebalance your portfolio. So I think you can, diversify by running multiple strategies if you have the mental capacity and wherewithal to deal with that added complexity. I think something people forget about is like the operational risk that you introduce by trying to do sophisticated strategies. Like, if you sit down at your computer and you're a discretionary trader, it's just you in the market and your mouse, and you're clicking and looking at the ladders and the limit book. And I'm simplifying it, obviously. But if you're running like an end-to-end automated system, then not only do you have to like find and capture edge in the market, but you have to make sure all your code's working and you're not making mistakes and your hard drive doesn't crash. So I think there's like added complexity at some point becomes not worth that added risk to take on the operational side. But I guess to more succinctly answer your question, yeah, if you can measure and if you're looking for diversification, you can run a intra-week option strategy and try to collect premium and run, collect cash, and then every month rebalance the stock portfolio, and you get some pretty good uncorrelated returns that way. Again, if you can deal with the added complexity of running multiple strategies.
Yeah, I was thinking about this myself the other day about how my trading and I guess other things in my life have kind of slowed down a little bit, and I thought maybe it was when I had kids. It seemed to, when I had kids and I was not getting enough sleep, and my kids have taught me a lot of patience. I assumed maybe that's why my trading's slowing down and everything else.
Yeah.
I like what you're saying there. So I want to go back now to a comment you made very early on, and I said I was going to revisit this one. I can't remember the exact wording you used, but you said you're hunting for complexity. What does that mean? Before I ask you another loaded question.
Yeah, it's a personality. I can't tell if it's a feature or a bug, but I don't know. I just feel like I'm always trying to learn hard things. Like all traders, this is a very hard game. One of the hardest in the most competitive arena there is. So why do any of us do it? I don't know. But I tend to, now I've kind of mellowed out on this in my old age, but I have historically tended to just make things very complicated. And now I find myself unwinding tons of this overly complicated stuff that I put together and just try to simplify it. And I've learned through many, many thousands of dollars of lost money that you hit diminishing returns by adding a lot of complexity. So I think it's my personality that I've just been on the hunt for like hard, complex things to deal with and learn. But now I'm trying my best to keep things as simple as possible.
Do you think there is more or less of an edge in simplicity?
Unfortunately, I think nowadays in modern markets, you have to get pretty sophisticated to compete. Now, sophistication doesn't necessarily mean complexity. So I don't know that you necessarily have to get more complex, but I think you definitely have to be using fairly sophisticated tools, which are kind of table stakes now, just to properly assess the data volumes that we're dealing with in an algorithmic trading sense.
Right. Okay. So as you were saying that, it reminded me of, I think you did a podcast, I think it was with Quantopian like a month or two ago. Mm-hmm. Yeah. And you briefly mentioned something about going back to first principles with a lot of the stuff you do. And that kind of got me thinking about what are the first principles of algo trading? How would you apply this? Actually, maybe you want to explain first what first principles are, what that concept is, and then how would you apply that to quant-based or algo-based trading?
So first principles, I guess I've never actually looked up the definition, but it's just kind of, in the way that I've always thought of it, is it's like learning something from scratch. Like you start at the very, very base level of assumptions and you build up the foundation from the very bottom most level. It's like thinking about machine learning. Yes, anybody can import a library, put the data into a single line of code and get some result. Learning that from first principles would be going through the underlying theory, the underlying mathematics, understanding what the test results mean on a very, very low level before you start implementing that work. So applied to kind of algorithmic trading, I mean, I kind of see it like, first of all, what is algorithmic trading, right? It's I see it as like using computers, obviously, using statistics, using mathematics to automate your expression of edge in the market. And that can take many different forms. So what are kind of the first principles that you need to know? I think data is important. I think getting a very good understanding of like market microstructure is also very important. This is like basically how the limit book operates. Spend a month like scalping futures contracts in a paper trading account on like your ladder screen, and you'll get a really good view of how the market behaves through time. You have to understand, like, if you're aggressively trying to get a price, what are the trade-offs? If you're passively getting a price, what are the trade-offs? I think next level are the tools. So, things like literally basic statistics that you learned in undergrad university. So you can get really far with linear regression or multivariate regression. I think a lot of people overcomplicate it and they look at very, very high end, countless times people are trying to pump data into a neural network. It's just like, start simple, start with the underlying statistical, like clustering, classification, regressions. Those three techniques alone, it opens up a whole world to you. So those techniques plus the tools to do it, like SciPy, scikit-learn, stats models, all powerful Python tools that I talk a lot about. I call it the Python quant stack. It's like the 10 libraries that kind of you use for this stuff. I think some basic machine learning can get you also very far. So I mentioned like clustering, classification. These things they're pretty simple, but they can get you very far. And then I think, obviously, this ability to think about the economic relationships and think about why Valero, for example, might be rallying with no news, right? It's not because some 50-day moving average crossed over 200-day moving average. Look at the oil markets and look at the RBOB and look at gasoline and see what that crack spread is doing. So that foundational kind of curiosity and the ability to link the economics throughout these markets, I think, is also super important. And then programming. So, I like to say Python is the new Excel. Python is kind of like table stakes these days, or, your language of choice are Python. I'm not going to get into the flame war for what language is best. Obviously, PyQuant news, so I'm a Python person. But once you can get good enough at these tools, you just open up an entirely new spectrum of possibilities to yourself. So, you kind of asked about first principles. I think it's these buckets of tools, these buckets of activities that are really critical for the non-professional investor and trader to really get into this.
Yep. Yeah. Wow, what an answer, Jason. There was so much to absorb there. I think we might, at the end, we might come back to how do traders get started in all of that you've said. Because, I mean, if they, beginner traders or maybe traders who are trading for a while, but they want to, adjust what they're doing, might hear that and go, well, that's so overwhelming. How do I do that? But it's really, I think, what I've figured out from you by following all your content is you can take a lot of these complex ideas and really simplify them. So I'm going to come back to that at the end and ask you for a simple answer to how people can get started there. But we got a bunch of questions in the chat as well, which I'm going to raise to you in a minute.
Cool.
But first, I wanted to kind of switch gears a little bit more towards finding signal, especially in the noise. We got some very noisy markets, and you've talked about finding signal a lot. First of all, what do you even mean by that? What is finding signal? Yeah.
I'm going to try to give you a non 3-minute answer.
It's okay.
but let me try to give you my perspective on what this means. So if you think of the market as a completely random process, all the data are random walk. If there's a repeating pattern, then you might consider that a break from the normal randomness of the market. And that's what you're looking for, is this consistent pattern that appears in an otherwise random process, okay? And that is what I consider a market inefficiency. It's some structural issue in the market that's causing a consistent pattern to repeat itself. And it's our job to amplify and detect that pattern and then figure out how to exploit it for profit. And then, of course, measuring if it's actually random or if it's actually repeating. So with that on the table, a lot of the concepts that folks are used to hearing about, you could consider market inefficiency. So think about a mean reversion process, right? We all know that volatility mean reverts. And if you consider volatility as a random process and you witness this mean reversion all the time, well, the question then is, how do we exploit? We're seeing the signal. So how do we measure this and how do we exploit it? So a very, very simple example could be like, take the z-score of your volatility, right? And if that z-score goes above or below 3 or -3, it's at some extreme. So this should catch your attention. Now, whether that's going to work consistently or not, I'm making no comment on that, but that's just an example. Another way you could do that is try to forecast volatility in a way that is better than the market. So there's these arch models, there's modified arch models. There's been thousands and thousands of pages of academic research on forecasting volatility. But if you can model volatility in a way that's improved over the market, then you can price your options more accurately and you can find yourself in a better position than the rest of the market. So these are the types of things that you think about. Now, it's not easy, right? I'm not trying to make it sound easy. I think there's often a lot of signal in these economic relationships. Pairs trading is very popular. Pairs trading is, you can imagine, two assets that are linked, economically linked. Think like Apple and Foxconn, and that relationship breaks, right? There's a dislocation in that relationship. Well, that relationship tends to be together. So can we exploit that temporary break for an opportunity to profit? That could be a signal for you. So, these are the kind of spaces where you want to look, you find the pairs that are economically linked. Geopolitical shocks, everything that's happening in Eastern Europe right now causes all sorts of opportunity to look for big market moves based on these geopolitical shocks, supply and demand, et cetera.
Yeah. You, as you were explaining that, you said the word structural inefficiency, I think it was structural. What about behavioral? Like, markets or market participants act certain ways around maybe specific price levels, or maybe some kind of indicator or price action. Does it have to be structural, or would you even consider that to be structural as well, like this behavioral aspects?
It's a great one. I think of technical analysis. When I think of technical analysis, I'm not a huge fan, so forgive me for those of you that are. But I think one of the only redeeming qualities that I find in technical analysis is exactly that. Is that if you've got this golden cross, well, every retail trader and their mother's brother and their sister is going to be looking at this level and doing something about it, right? So there's some counter positioning that you can take advantage of there. Now, of course, the question is, can you consistently do that in a way to consistently make money non-randomly? I think that's that next level question. But to your point, yeah, absolutely. There's this herding behavior. We've seen this, and most trends are because of this behavioral aspect, right? Like, new information isn't priced in fast enough, then all of a sudden it is, and then you've got this herd behavior like NVIDIA, right? all of a sudden the world woke up and realized that every single generative AI application is based on GPUs, and guess who's the best provider of GPUs? NVIDIA. The whole world woke up to that. I mean, NVIDIA's gone up, what, $1 trillion in market cap in like 12 months.
Wow.
Clearly there's some herding going on there, some behavioral thing.
Yeah.
So there's definitely that as well.
Yep. Okay, I'm going to ask you quite a broad question and let you answer it how you see fit, and then we'll get into some of the questions in the chat.
Cool.
Where are the market inefficiencies today? Where would you look?
The crack spread's a good one.
Yeah.
You can start to find some mean reversion happening here now that the kind of trend of the overall market has started to become exhausted. You can find some names that are overextended and starting to mean revert. I trade a momentum factor, and that's been behaving really poorly lately, which typically tells me that the market regime is shifting. Now, it's obvious to see that, but if you can build a portfolio of assets that are exhibiting lots of mean reversion, then you can absolutely capture some edge. Now, this is a portfolio-based strategy as opposed to necessarily a single asset or spread strategy. I think the pairs trade is always a good one. It just depends on how big of a universe you can search. And then I'll say it again, the crack spread is still working. There's a uranium trade that's been quite good. So if you can find all the uranium names, there's some regulatory constraints that impact certain uranium producers from exporting to the US that you might be able to exploit. So we've seen that trade work pretty well over the past couple of months too.
Sounds like you do a lot of keeping in touch with the news, looking at developments in geopolitical developments, and so I guess that may bring up different opportunities as history reveals itself. So
yeah, I think so.
I guess you don't run out of ideas to test. Is that an assumption?
Yeah. I mean, that's kind of the problem. It's like you've got this backlog of stuff to test and only so much time to test it. What I found super effective is you find one strategy and you just express your view in many different ways. So the crack spread, I keep going back to this because it's like taking money from a baby. But you can trade the futures, you can trade the options. Obviously, if you're an options trader, you know that there's an infinite number of ways you can express your view in the options market. That's such an underrated way to continuously capture edge on an idea. For sure. Somebody said something, I read it somewhere. It's this concept of a luck surface area. Like the more you read, the more you consume, the more you know in an intentional way, the broader the surface area that you have that helps you get lucky with stuff. And I kind of see it with trading the same way. The more you know, the more opportunities you'll be able to put together. You'll be able to piece the puzzle together, put two and two together in more ways than your competition. And that's what edge is, right? It's making money on the margins where you have some informational advantage for some reason. So that's kind of the perspective I take. The more I can consume in an intentional way, the more opportunities will present themselves through time. Yeah.
I really liked that. I read a book, I'm trying to remember the name of it now, but it was talking about creativity. Mm-hmm. And, the whole idea was to consume a lot of broad knowledge, even in outside of trading, and just synthesize it all, let your brain think about it, and you come up with all these unique ideas. And if you look through history, there's quite a few examples of someone taking an idea from one what's the word, not sector, but one domain, and applying it to another, and revolutionizing that. So I really like that. You what did you call it? Luck surface area.
What was
the concept? Luck surface area. I really like that. That's pretty neat.
Not mine, but I'll.
Yeah.
I'm not going to claim it's mine, but I use it.
Yeah. Now we've got a couple of questions here in the chat. Excuse me. So I'll have a crack at some of these.
Cool.
There's a long one here from Charlie. First of all, Ilya said Quantopian, didn't they shut down long ago? Maybe was it Quantopian or someone? Who did you have that interview with?
Quantopian shut down. They got acquired by Robinhood. John Fawcett bought the rights to the email list and he's kind of resurfaced Quantopian in the last couple months as a community and as an email distribution. So it's more of an educational content. You don't get the cool platform and all that. But you go to quantopian.com. I'm pretty sure that's the domain, and you'll be able to sign up for the newsletter. It's like long reads once a week. Like, let's look at a strategy and go 5,000 words on that strategy. But yeah, he's back.
Okay, cool. I wasn't aware of that, so thanks for explaining that. I'm going to put this question on the screen. I'm not exactly sure what they're asking. Maybe you know. If not, then we can just skip it. But I have a question. Can someone answer, please? If my balance curve is growing smoothly over time and my equity curve's having trouble to meet the balance curve, what does that mean? Any ideas to smooth it?
Don't know what balance curve is.
Okay.
Yeah, sorry for that.
Yeah, if whoever posted that, if you want to just clarify a bit further, that'd be helpful. Yeah. Okay, this one's a long one, and we kind of touched on this a little bit, but let's have a crack at this one from Charlie. Thank you, Charlie. So I'm going to read it. It's a three-parter. Hey, Jason, I fully appreciate that the correct way of doing quant trading is having a trading strategy based on some economic relationship and then improving it using machine learning or AI. My curiosity got the best of me, and I've tried using data mining to build trading models using economic features without providing an economic relationship. All validation tests have passed, and the models keep working during live trading. My question is, if the models cannot be fully understood, but they make money, does that invalidate them?
It's kind of a question old as time, Charlie. I mean, ultimately, it comes down to two things, right? If your model's making money, great. Put on some very good risk management, right? In all cases, you want risk management. I'm not just talking about stop losses, but whatever your style is, make sure that you're implementing, the appropriate level of risk management just to protect the downside. I don't want, I talked about data mining, and I don't want folks to get so caught up on definitions, right? Like, ultimately, if you've got a model that is statistically significant and you've got enough data points to show over the long run it can consistently make money on a non-random basis, then you're probably in good shape. Like, who can explain how large language models work? Not even the PhD scientists that invent them, right? So there is always going to be an element of this black box where you put data in, it does its thing, and the stuff comes out. But going back to first principles, it's just important that you understand the theory and, most importantly, the assumptions behind that model. So, for example, does your model assume a normal distribution of asset returns? Well, if the answer is yes, then you're violating that model because your asset returns are not going to be normally distributed. I mean, that's a pretty known thing. That's why a lot of time series don't work in the markets. And that's why the markets are hard, because they're non-stationary, right? And all these things, you just need to be careful that you're not violating the assumptions of the model that you're using, and make sure that you're doing the appropriate testing on the back end to show statistical significance, and put on your risk management. And who really cares if you can explain what this column of data means if your model is performing and it's and you're sure that it's correctly, accurately representing what you think it is.
Yep. All right, thank you, Jason. Well said. Hopefully you found that helpful, Charlie. Great question. Thanks for posting that one.
Thanks, Charlie.
World of Thor would like to know a starting point for a newcomer. So this goes back, I guess, to our first principles discussion.
Yeah.
But what do you recommend for someone who's starting out?
That's great. So I think the mental model, I'll talk about the mental model, and then I'll give you the answer. I think the mental model is this going to be a part-time thing, or is this going to be a full-time serious thing? And it means two very different things. If it's a part-time hobby thing, then you've got to manage your expectations that, you've got to carve out the time. If it's a full-time thing, then you got to treat it like a business. Okay. So that's kind of like the very first conclusion that you have to draw for yourself. Now, more practically, I think the best way to do this is to get the market intuition by literally staring at the markets for like a month or 2 months. Get yourself a paper trading account and just just stare at the limit book on these things and actually enter limit orders and enter market orders. And, in your paper trading account, buy the offer and sell the bid and see what happens and see how the market reacts and see how, all of a sudden there'll be a 5-tick spread in a market because some news comes out and the liquidity dries up. Well, what if you had a position on? What are you going to do about it? The more intuition that you can get on how the market behaves, the more comfortable you will be. Okay. So after that, I think you got to learn the tooling. And again, if you want to get into technical analysis, then figure out how these things are calculated, talk to people, understand what works, understand what a breakout means, understand what consolidation means, understand what patterns to look for, a lot of rote memorization, a lot of pattern recognition. If you're trying to go the quant route, learn Python, full stop, learn Python. That's it. Take a $19 Udemy course. You can read my newsletter. I think I've got 80 weekly newsletters out now. You can read them all. You can join the newsletter and get them in your inbox. You can take a $19 Udemy course. You can do whatever you want, but get yourself very comfortable with the Python syntax. Loads and loads of free content out there, free courses, paid content. Spend 3 months getting good at Python. Spend 3 months getting good at Pandas, P-A-N-D-A-S. So Pandas is the data manipulation library. It's at the heart of everything we do in quant, everything we do in data science is this Pandas library. And then all the while, just read, read about the markets, listen to Better System Trader, listen to people with experience, listen to people who have done this, read about their exploits, read about their losses, just read, expand that luck surface area. And then after 3 or 6 months, you'll be in a pretty powerful position to start. Okay. Then you can kind of start thinking about how to apply all this knowledge to the actual markets.
Yeah. Yep. Well said. Thanks, Jason. Also, I know you're kind of a humble guy, but you've got a Python course as well, which has had over 1,000 students through it, and you're well known for it. Do you want to just explain a little bit about what that is and how it might help people who are either getting started in trading or want to, expand their skills?
Yeah, thanks, Andrew. Thanks for the opportunity to pitch.
That's okay.
I teach a course called Getting Started with Python for Quant Finance, and that's exactly what it sounds like on the tin. You come through, you get 10 live sessions, and essentially by the time you're finished with the course, you have a very, very firm grasp of the tools that you need for quant. And it's tilted toward algorithmic trading. I cover things like beta hedging, factor analysis, factor portfolio creation. We go all the way through algorithmic trading, where you're literally connecting to an interactive broker's account with Python, entering trades, downloading data. It's a pretty broad and I would say relatively deep treatment of all of the tools that you will become very familiar with in a career in quant with Python.
Yep. And I know you've been very kind to offer a special deal for Better System Trader listeners. So if you want to know what that is, I'll just post it here in the chat and I'll put it on the screen. And we've got 2 more questions here. So do you have a couple more minutes of your time, Jason, to approach these ones? Okay. Yeah, so the balance curve question is back, and I think I know what they're asking now. So let me put this one up on the screen.
Okay.
The balance curve is the amount of money I'm winning. So I assume that means open equity. What I mean is I'm making money consistently, but my equity curve, or maybe closed equity, struggles to meet the balance curve. What would you recommend I'm trying to...
So is balance...
the original question was, any ideas how to smooth it? So what I think they might be asking is they've got, depending on how they trade, I guess they've got a lot of open equity. And when they close the trade, it doesn't look as good.
Okay. So there could be a couple things going on. I mean, I don't know what the size that you're trading, but you might consider transaction costs if you're trading a lot. You might consider market impact if you're trading large. Are you using market orders where you're paying the spread? If you're paying, are you transacting in low volume, low liquidity assets? Oh, that's for my camera. You might like, I used to trade options when I just started and I was dealing with like 50-cent spreads. So I'd get stuck and have to pay up to get out of these trades, and I would just get smashed because of that. So are you trading illiquid securities? Are you trading liquid securities? Are you trading market orders? If you're experiencing a lot of adverse, market reaction, try limit orders, try trailing stops, where if you buy at 50, the stop loss will follow you up the price curve. These are types of things that you can do to kind of reduce the volatility in your equity curve. If you're so I think I know what you're saying now, Andrew. So a lot of unrealized gains, but then when you go to realize them, maybe a loss, right? So that's probably a discipline problem, which is not unique, right? Getting in is the easy part. Getting out is the hard part. So it's probably risk management. Double down on your risk management. Think carefully about how you're managing your risk. Think carefully about the types of orders that you're executing, the size of your transactions, and the securities that you're trading in. Make sure you're trading liquid assets. Make sure you start with some tight stops. Try trailing stops, and make sure that you're not trading market orders all the time and getting smashed on the spread.
Yeah. All right, thanks, Jason. And one final question here before we wrap up. Ilya, let me put this one up on the screen. I wonder if there are Python specialized backtesting libraries. Vector BT feels like a premium library. Backtrader seems simplistic.
So it's a great question. I teach Zipline Reloaded and Vector BT in my course. And the difference is that there's two different types of backtesting frameworks. There's event-based backtesting frameworks, which Backtrader is one of. And then there's vector-based backtesters, which Vector BT is one of. So it's not a matter of premium or not premium. It's a matter of the use case. So if you're trading a portfolio of assets, so I think the best use case for Zipline Reloaded is these factor-based portfolio strategies, because it has a factor mechanism that you can rank factors and build these portfolios, but it's slow. Vector BT is exceptionally fast. Like, talk about 3 or 4 million simulations in 3 seconds. I've written 4 or 5 newsletters on Vector BT. I know the developer Oleg, but you get yourself into trouble because you can easily data snoop and look ahead into the future because you're applying your calculation all at the same time. So it's more about the type of strategy that you're employing and the right tool for the job. So I teach both of those in the course that I mentioned, to give you a very good insight into when to use each, what an event-based backtester is, what a vector-based backtester is, et cetera. That's a good question.
Yep. All right. Excellent. Thank you for the question, Ilya. All right. There's one question that's just popped up. Okay. Do you have 2 more minutes, Jason, or do you have to rush to a meeting?
No, I got you.
I'm interested to see what you say about this one.
Okay.
It's a little bit, I've never heard anyone ask this question before. What is the best thing you did once you started becoming profitable?
The same thing. I mean, it sounds cheeky, but like, I literally just doubled down on the exact same thing. So I had a stretch of like 19 months where I was selling credit spreads on AZO. Now, to tell you how long ago this was, AZO is now a $2,000 stock. I was selling credit spreads at like $160 strike. And I was doing this every week, and I did it successfully. I had the same strategy. I was selling like 15 net delta calls, iron condors. I was covering them at 10 days to expiration, the exact same trade every week for 18 months. And I think I lost money twice. So to be like a little bit more general, you put the measurements in place, you put the metrics in place to measure your win rate, alpha, whatever. Then you just trade the same thing as many times as you can until your metrics are telling you that there's no more edge in that strategy. That is the best. I've never been asked that either, but it's literally, that's the best advice I can give.
I guess it's a human tendency, though, to tweak things when they're working, right? How do you keep your fingers off it?
Exactly. That's a great question.
Discipline. Chris. Yeah, thanks for that question, Chris. That's never seen that one before. All right, Jason. So thank you very much for your time today. I appreciate you. We went a little bit over here, so thank you very much. How can people get in touch with you or learn more from you?
You can go to twitter.com/PyQuant News or my website, pyquantnews.com. And then I'm also on Twitter at /Jason Strimpel, just my name. I post 4 times a day on Twitter and LinkedIn under my PyQuant News handle. I've got a weekly newsletter that goes out with real Python code. I would encourage you to sign up for the newsletter if you're interested. I've also got this course that's closing on Saturday night, US Eastern time. If you're interested in that, jump on, and then you can email me at jason@PyQuant News if you'd like to get in touch more personally too.
Excellent. Thanks a lot, Jason. And I just realized I didn't put the link up on the screen. So if you're interested in a special little deal that Jason has given graciously to us for Better System Trader listeners, go to that page and I'll send you details about that one. So Jason, thanks again for your time today. Any closing comments or questions? Anything you want to share before we get on with our days?
No, I could give you an encouraging comment about keep your head up and keep chugging, but we all know this is a hard game and it's a grind, but it's been an absolute pleasure, Andrew. Thank you so much for inviting me to the pod. It's great to get to talk to you, and thanks for all the great questions.
Yeah, likewise. Thank you very much, Jason, for sharing all your insights, and thank you to everyone who joined us live today. We had some great questions and comments in the chat, so thanks again, and I'll see you again soon, Jason. And
sounds great.
Yeah, happy trading.
Happy trading. Cheers, everyone. Bye.